The market is changing. Are you aware? Stay tuned. Welcome to this week's edition of NoteSchool TV. Yeah, where every week we bring you the most amazing updates, the most amazing guests, and today is a fan favorite, and that is the April 2025 market update. Wow, it's been a big month in April. So let's do a little housekeeping before we get started. Number one, make sure and hit that like button. Yep, just take a second and hit that like button for us. Share this. This is the big one. This is the big one that everybody does like to share with their friends, associates, everybody they know. So make sure and share this week. If you have not already subscribed to NoteSchool TV, go ahead and do so. And then number three, hit that bell notification so that you'll be reminded every week right before we go live when 11:05 Central Time. And if you would like more information about what we do at NoteSchool, simply go to noteschool.com/TV. Again, noteschool.com/TV. Sorry, guys, tongue twister there. All right. With that, I want to bring on, our chief visionary officer, founder of NoteSchool, and all-around good guy, Mr. Eddie Speed.
Good morning, Joe. I didn't
morning.
Twist you up with any of that.
I know, right? Talking like a wascal wabbit, right? Oh my goodness! So, how are you?
I'm good. I am. I hate to come on every week and say how busy I am. That sounds like, I don't know, whatever.
Yeah,
Joe, you are right. The market is changing.
Yes,
and the level of awareness that we want people to have is why we do all this. And this is why we have the market update. And it's why we talk about it. And Joe, let me start out by saying, guys, when we pose a problem, we also try to be in a position to pose a solution.
Right.
We're not just posing a problem, but we're trying to tie it in. Now, sometimes it's just news and, we don't have the answer. We're just reporting the news. And sometimes we're reporting the news, but we have a solution. And today, I think we're going to leave here with some solutions. But let me just tell you something, Joe. I'm talking to some guys that play at a pretty high level, and everybody's pretty much talking about it. There's some weird vibes in the market, and we're going to talk about it. We're going to talk about what the components we think that are worth paying attention to.
Absolutely.
Well, I'd say let's bust it open and let's go chase the rabbit a little bit.
Let's go do it. Yeah, it's a great picture there with all those cul-de-sacs, right? So let's talk about the housing market. Eddie, from our friend John Burns over at John Burns Research and Consulting, from an investment point, do you believe it's a good time or a bad time for someone in your area to purchase a home? And of course, we've got the three different pricing categories here. And so most people are saying, a big majority, that it's not really, or they just have no opinion.
First of all, I don't know how many people are buying a house less than 50 grand. And that's kind of interesting, but we used his chart and that's what he used. So there you go. I'm not sure how many people are buying a house less than 100 grand.
I know, or even 150 grand, right?
Well, even 150 grand, maybe in smaller markets or smaller situations.
Right. And there are.
Here's the point. Ironically, right now, two of the smartest people I know in real estate happen to be buying their personal home. And that's just because their life circumstances.
Mm-hmm. Mm-hmm.
It's not like they're unaware of the market. They're crazy aware of the market. It's just time for them to make a change.
Yeah.
Right. But I would say from an investment standpoint, I can understand why the market is showing these flags.
Yeah.
And, less than 30% in both cases are in the categories are saying it's a good time to buy. And that is because of all the things that we're saying. And I don't think necessarily, Joe, people know all the data that they're making a decision.
Right.
But it's instinctively things don't feel right. And the answer is they're probably right. Things don't feel right.
Exactly. And there's just a little bit of uncertainty. Our friend Pat, right? That's what he used to always say, that uncertainty. People want certainty, but it's very uncertain at this point.
Yeah.
Yeah.
All right.
Let's look at the median prices of homes in March. This is interesting, Eddie, because this is the first time that we've had the new home price and the existing home price that's so close to each other, right?
And why that matters is because of the fact that people with existing homes think that builders are not their competition.
Right.
And I have people tell me this, and I'm like, what?
Yeah.
And like, there's some kind of belief system that says it's not the same. And why does it matter is because you need to then be fully aware of what builders are offering.
Right. Exactly. They can get you a better, typically they'll buy down the rate, and we're seeing the number of incentives that the builders are giving is going up. But, interestingly enough, the tagline on the bottom is starting to crack. And that was about a year ago. That median price was about $431,000.
We're not in Kansas anymore, Joe.
Yeah, let's look at the next slide, Eddie. Oh, so home prices falling. Austin is leading the board, man.
It is. And, all the places that thought they couldn't have a dent in them, let's just call it flat. Austin's not flat.
Yeah.
But let's call it flat. There's a lot of markets it's not flat. Very sophisticated investor is buying his personal home in Dallas-Fort Worth, and he says the slippage in Dallas-Fort Worth has been between 6 and 8%.
Yeah.
I don't know what the stats say. I'm just telling you, this is one of the smartest guys I know.
Right. And look at four of those 10 markets are in my state here of Florida. And yeah. So,
well, those year-over-year listings, Florida's trying to lead the nation there, Joe.
Yeah, for sure. We could spend the whole episode talking about what's going in Florida, but we're not going to. So let's go to the housing market affordability. This is from our friend Lance over at Fast & Company. And market affordability is so stretched that it hits a 40-year low. And yeah, when you're looking at the seasonally adjusted, this isn't what sold in January, 4.8 million. Or 4.08, but that would be the seasonally adjusted, and then we can see the lowest annual level since 1995, according to NAR.
You know what, Joe? When you start seeing these 40-year terms, 40-year things, it all starts to pay attention. I don't know why 95 would be. That's funny math, but
Yes. Yeah, I know. I don't remember anything significant happening.
That's a 30-year term, not a 40-year term. But
right.
Anyway, the point is this is the elephant in the middle of the room is affordability.
Exactly.
Right. Houses went up in value. People can't afford them. People's salary didn't increase at the rate houses increased. And then all of a sudden on top of that, then you had interest rates essentially triple.
Yeah.
Right. Well, all of that doesn't make the greatest combination in the world, right?
It does not. So let's look at builder unsold inventory jumps to 2009 levels. Now, we do know
what was attention.
Yes, what was going on in 2009, right?
Like this is, if you're in lending or you're in real estate and you're unaware of the builder situation, like, let me draw your focus to it. This matters. And look at that spike, Joe, between 23 and 25.
Yeah. That looks like those, just a typical spike for a lot of the things that we look at. Just either that just rose, and then we look at the mortgage credit availability, and that just fell off the face of the earth.
Well, let me just say that if you look at a spike between 2005 and 2007, and you're looking at the arc level,
yeah,
all right,
that's where Noah settled the ark, right?
That's kind of that. We're not at that point, but understand that we are overbuilt. It's not selling. and a fella would pay attention to this.
And a lot of the overbuilding was done, Eddie, in 2 states, Florida and Texas, right? So that's what that looks like. Now, I thought this was interesting, Eddie. Home sale cancellations surged nationwide as thousands of deals fall through. 52,000 fell through in March, which was 13.4% of the homes that were sold in the same month.
Yeah, I mean, so once again, like, what does that mean? And then you look below, when you're looking at places that we all had really thought were hot, there's good old Texas in there,
And here.
and of course Florida,
Yep.
and California, and you start realizing that these are cusping right at 20% cancellations.
Yep.
Deals are falling apart. Now, we're not Seattle. We're not Seattle.
Yeah, I hesitated to put that in there, but 71.3% of all home transactions, the sellers were offering concessions. Yeah.
By the way, we heard a little bit about concessions as we rolled through last year. We heard a lot about builders giving concessions.
Right.
Now, all of a sudden, home sellers' concession numbers their existing homes are becoming very similar to what we're seeing in building. So the point being, the market's getting softer. Deals are harder to make. It's like I went and got my hair cut yesterday, and my lady in the chair says, "Eddie, are we in a buyer's market or a seller's market?" I get confused.
Yeah.
And I said, well, I can tell you what we used to be in, and that was called a seller's market. And now we are quickly have switched hands, and now we appear to be full-fledged in a buyer's market.
Exactly. So let's look at, this is the active listings, and we're still holding at 33 to 34% down here in Florida. And that's the change between March of 2024 and March of 2025. Listings up, and we see them all over here, right? There's Nevada, there's California, here,
Arizona. It's the bottom line is these are telling you we have a growing inventory, and I've always placed a really high focus on extending days on the market and extending listings as being an indicator. And once again, I want to be clear about this. I'm not calling for a 2008, okay? But I can tell you, in 2008, I was coaching a bunch of people in the note space, and they said, Eddie, prices aren't really dropping. They said, no, the days on the market are crazy long, but prices aren't really dropping.
Right.
And the answer is, I said, that's because they're all in foreclosure.
Yeah.
And by 2009, now all of a sudden it went from who was selling the house from the property owner to the bank.
Right.
Now, I'm not saying that all of that has come to roost yet, but these are indicators. Yeah. These are storm indicators. So be prepared.
Let's look at here's some CoreLogic stats from the end of the year. And these are just out, fresh data that's just out. But the red are the top 10 states with the highest average gain in equity, which, we're looking at California, and we're looking at Nevada, Wisconsin, New York, Maine. But then you can see a lot of where it's very little, and we're here in Wyoming and Idaho. But look at Oregon, and Texas, Florida. I think we're number one. Well,
Joe,
New Jersey's number one.
Let me just tell you this, Joe. When you look at this, here's what this tells you. Okay? What this tells you is that we're pretty much in a flat market.
We are.
There are some micro markets that aren't flat. $14,000 increase in California on the price band of what houses bring in California. That's virtually flat.
Yeah.
Right?
Yep.
This tells us that last year was kind of a flat market, right? Once again, you can look at a big hike in New Jersey. I got a property in New Jersey right now, Joe, by the way.
Yeah.
I really do. I'm not kidding about that.
Yeah, I know.
So I'm excited to see that New Jersey's okay.
Yeah.
But here's the thing about it. For the most part, we've been in a flat market, and people are watching what is going forward. And this is a little bit looking in our rear view mirror, which we need to do.
Right.
But it kind of gives us an indication of where you thought we were last year is like, okay, you were probably right. Because people's like, I just don't feel like it's doing much. And you look at the change, whether it's a minus sign or a plus sign in front of it, it's not much change.
No. When you're looking at a $400,000+ median price, $5,000, $8,000 doesn't really move the needle at all.
Yeah.
But it is flat for sure. So there's our old buddy, the elephant, and the affordability. So how do you feel about the trajectory of the U.S. economy over the next 12 months? Well, in December of 2024, people were feeling a little better about it than they are in March of 2025. So a good 46% are saying, "Hey, yeah, we're a little concerned." But
Well,
it's not that much, between, these numbers just kind of reverse.
I think the notable thing is people being very pessimistic jumped 10 points.
Yeah, that's it.
Right. And so that's really kind of where we are. And I would say that's pretty much true at a unsophisticated level and at a sophisticated level.
Yeah.
And part of it is true. Other thing is, Joe, just to be honest with you, it is a lot to do with who you voted for president.
There you go.
Right. Because we got, as always, but we're not lacking any of it this time. We got drama.
Right.
And so, we've got all these variables. And so I just think it's, it's not like we're all a green light. And part of it is that we kind of knew that was coming. If you're going to go, you're going to go tear it down, which is kind of what Trump said he was going to do. And it ain't all going to be good. It's not going to be every day's the best day.
Right.
Now we'll why don't we just look at the results as things unfold? How about that?
Let's do that. Yeah. Mom said there'd be good days and there'd be bad days, right? Going half mad days. Yeah. All right. And this is just similar, how concerned homeowners are about housing affordability in their market. Overall, 49% down here for the U.S. are very concerned, and 35% are somewhat concerned.
Hey, Joe.
Yeah.
I would like to beat that 5%. I would wonder what a conversation with them would look like.
Yeah, they may have a helmet on with some... Anyway.
Yeah.
We're not going any deeper into that, but yeah, and you look at, the West is the most that are very concerned when we look at the different parts of the country. So yeah,
everybody's about 50% plus or minus, right?
Yeah, for sure, for sure. Let's talk about the banks, lending, and the Fed. So, Eddie, I did a little research. So here's where we are right in here with the APR. But I looked back at April of 2024, and 30-year fix was at 6.99. So it's about the same.
Yeah, I think that's how people see it. People are watching the 10-year treasuries, which really is what affects mortgage rates, and trying to read the ball in it. And I don't feel like, there possibly is going to be a little bit of a decline in rates, in the summer. Is kind of what some of the experts are saying. Yeah. And then we don't think we've clobbered inflation. Okay. So for those reasons, I think it's going to, we're not, there's not some big change in the market that's drastically going to change it. Right. And people can say what they want to. People get all fired up about a 0.5 point drop in rates, and I don't see the evidence that tells me
there's a much bigger picture out there, Eddie. And I did check non-QM loan, right? Non-conforming, non-QM loan rates right now, and they're in the 9 to 12 range, depending, and there could be some points, 1 to 2 points on top of that. So, we're right there on those as well.
All right, let's do it.
Let's do it. Mortgage credit availability, it's still one of those things. Sorry, went too far. It's what it is. And we know, Eddie, that, there's 40%, right, that just are the left behind. And that's our self-employed, contract, gig workers, I-10 borrowers, foreign nationals.
Commission people.
Yeah.
All those things are people that have been the most affected by this big whack in underwriting since the virus started. We think that seller financing fills a gigantic gap. Seller financing really is non-QM lending, non-qualified mortgages, which is about 40% of the mortgage market.
Yeah.
So we're continue that this is a trajectory that we're on, and seeing that there's an underserved market, and not what we would say is a lot of times there's an underserved market of the obviously missed, Joe. What we're looking for is the just missed.
Right on that precipice. Absolutely. Did you know, Eddie, that ICE, Intercontinental Exchange, they also own the New York Stock Exchange?
That's
Fun
cool.
fact. Yep.
Fun fact.
Yep. Morgan Stanley expects no rate cuts. The Fed will have no rate cuts this year. They're saying due to some of the tariffs and so on. But plus Morgan Stanley, plus the rest of the Wall Street brokerages had expected a 25 basis point cut in June, but some of them are now rethinking their positions on cuts being made as well. So we'll just have to see, but that's kind of right in line with what you said a minute ago about, we could see a little tweak, but probably not a whole lot. We're probably where we are.
Yeah. Now remember, Fed rate cuts usually do not affect mortgage rates. It's the 10-year T-bill is the biggest indicator of it. And they track, but they don't exactly align perfectly. So
no, they don't. Right. That's the Fed fund rate is the rate that the banks can borrow overnight, their open market window overnight to clear their books. Banks have to balance their books every night, and sometimes they have to go in and borrow a little money to do that.
Over a long period of time, this is normal. This is not abnormal.
Absolutely. All right, so let's look at the different cycles and where we are in 2025. CoreLogic did announce that single-family rental growth drops to a 4-year low. Got some more stats on that, but rent growth declined by 2%. And, that's just where we are right now.
Yeah, rents are flat, if not dropping.
Yeah.
Generally speaking, and this is our thesis.
Yeah.
Basically, when you saw that little circle, the last one that filled in was this year. And it doesn't matter what happened yesterday. It doesn't matter what happened in 2018.
Nope.
This is not the same economy. We're not in Kansas anymore, right? As they said on
yeah, that movie, right?
Yeah, that movie.
Well, here's a U.S. rental market. We're talking about single family rents here, Eddie. The average is $1,828. Month over month, year over year is down on between $250 and $275, and that's with 731,000 of the rentals reporting. We know there's a bunch more than that, but that's what it looks like. And Eddie, talk about the 50% rule.
Yeah, so basically 50% of the rent you're collecting goes out in expenses, and that's been a standard, but it is now pretty much a gold standard. Joe, I have a value in that slide when we're doing our presentations. So It's a great slide that kind of shows this isn't, we know that we're not making up the numbers. We've had numbers people give us the numbers, but this has kind of been our thesis on this. So 50%
here's the top 10 markets, biggest drops by percentage. Austin, New Orleans, Phoenix, some of these went up crazy. Here's Dallas right in the middle here. And so Houston, but that we know that this is the case here, and we know, Eddie, that's why this is a note market and not really a rental market. Talk about this,
Joe. Here's the bottom line. Like you saw that last slide, and it says rents are going down, and look, they're about flat.
Yeah,
right. Rents are down 2.5%. I'm not sure on a monthly basis you can That might be
Yeah.
might be $12. Okay.
Right.
But here's the real truth. This house, Joe, in 2018 was worth $125,000.
That's it.
And you were netting $9,000 to $10,000 in income. It was an 8 cap.
Mm-hmm.
Okay. This house today is worth $250,000 and its net income is a 4.3 cap. And that is normal in most markets. And we run analytics on this all the time. What this means, Joe, is pretty simple.
Mm-hmm.
Your house doubled in value, but you're not getting paid for the equity.
That's right.
Which leads us to the next part.
I love you guys are going to love these guys. The milkshake.
Well, what happened is, and this is what is caused part of the math drama. Rental income increased. This is on a rent house. Mm-hmm. Rental income increased, but it didn't pace with expenses. So yeah, your house rented for more money, but it wasn't commensurate with how it went up in value.
Yeah.
Your house doubled in value and 20% increase in rents.
Mm-hmm.
But worse than that is that your expenses were way higher increase percentage-wise than your rents. Yeah. And inflation drank your milkshake. Inflation drank your joy. Your house went up in value, Joe. You're just not getting paid for it.
Look, if I went to Steak and Shake and that's what my milkshake looked like to drink, I wouldn't be a happy person.
Oh,
let's talk about the sandwich.
Well, so what's happening today is that real estate investors were buying rentals and they were making an 8 cap. Now I'm overgeneralizing. Like that may not be exactly true in every market. But what happened today is a house in certain markets that you could buy and the net income, the net income was 8% a year before debt service. And now all of a sudden, Joe, the same house today is identically the same house is earning a 4 cap. And so what you find yourself doing is your house got equity, but you're not getting paid anything for it. Right. And I don't know what you put on that equity sandwich, but that's apparently what one could look like to try to eat it.
Yeah, we could have put some anchovies on there, and that probably wouldn't have been very good.
All right.
Let's talk about them. Yeah, here we go. And guys, this is what we showed you. The average rent's $1,828. So there's what it looks like.
So Joe, 50% of that means that house makes $900. Seller financed the same house with about a $2,000 payment, according to non-QM rates. And understand today, then that's your math, right? And when you look at this math over and over and over, you're looking at about 2.5 times the income you can make on a rent versus a note on the same house. And this is just the math, right? And we challenge this and we show people how to do it. We give them a spreadsheet and let them run their math. We don't try to make up the numbers. They give us some of the results, and this is what we're seeing over and over and over. Generally speaking, today, it is probably a fair statement. Generally speaking, probably not 100%, not every property, not every asset, but generally speaking today, Joe, it is going to be more profitable to rent as to seller finance a house than it is to rent it.
That's it.
Now there's exceptions to that rule, and we're not saying everybody's going to sell every rental in America, but the wave of people doing this is pretty drastically different.
All right. Let's look at the commercial multifamily, single family side of this. And so here's from TREP, which is, Eddie, it's a gold standard, right?
Yeah.
So how evolving supply demand dynamics. There's a lot on this page, and I apologize for that. But 592,000 multifamily were completed in 2024. And look at that number. Biggest 1 year increase since 1974. Eddie, we're looking at higher vacancies and downward pressures on effective rents. And this is the biggie. Now, this is over 5 years, right? But from 16.5% increase to a 99.5%, almost 100% knocking on that door, increase in expenses over the last 5 years. And Eddie, this isn't just multifamily doors. This is multifamily projects. So 5,100 multifamily projects. Look at their debt service coverage ratio is below 1%.
They're not making money.
They're not making money. And look at this. We got another 750,000 that are under construction and that'll be hitting the market.
Yeah.
So
look,
when we
everybody knows, it's hung out with us a long time. We've called this ball literally 2.5 years back and say this was headed for a bad spot. 2 years ago, Joe, most of our audience, quite honestly, thought we needed to be in a straitjacket. They thought that this couldn't be true, that there was nothing on social media, nothing in the market that didn't say it was going to be incredible. And now pretty much people have figured out we're right. Let me tell you something, guys. We weren't smart. The data was all over the place. We just weren't emotionally charged, right? The data was all over the place.
Yeah.
And so, Joe, I would say that this completion and looking at this big hockey stick up and how many units were complete, how many people are just thrilled that they got in that project, like are thinking that it looks the way it did when they started. Problem is there's a 2-year cycle when you're doing apartments. There's a 2-year cycle to it, right? And so by the time you start it, by the time you start realizing there's a problem, you're already committed. And this is where I think a lot of operators are.
Yeah. Eddie, there is one silver lining in this, that if the operators can hang on until 2035, that this all is going to be back to normal, because they say we need another 4 million apartments by 2025.
But 2035.
2035, yes, thank you. Yeah. All right, and here is the distressed property type.
I want to emphasize this. This is not new information.
No.
This literally was in the fall of 24.
Yeah.
And that was what the Wall Street Journal predicted of what had currently happened versus what they projected. And when you look at apartments, you can see that's what they were doing, is looking down the road, which is what we've been doing. So I'm just saying, we went back a little bit just to say, what have people been saying and what is the market then showing? And the answer is the data is pretty clear. Now, once again, there's other areas that we don't talk about as much: hotels, industrial, things like that, because quite honestly, there's just not as many small investors that are invested in those kind of syndications. So
that's true. And apartments, 81, almost $81 billion are potential here. And it's less than office. I mean, it's more than office, right? Which is kind of crazy. All right, let's wrap it up with non-performing loans. So Eddie, Fannie and Freddie single family, multifamily, serious delinquent rates increased again in March. Minuscule, right? I mean, 0.5, half percent. Same way here. Multifamily delinquency rate increased in March, highest level since 2011 on multifamily, and Freddie also experienced delinquency rates increasing in that sector as well. And VA, the Veterans Administration loans, are the highest number of foreclosures that are going on right now. So I looked at these numbers, Eddie, and so I highlighted the ones that are really the ones that are significant. So there's 221,000 that are in foreclosure, but the number of days, 90 days plus, is 647, and the average days delinquency for these foreclosures are 1,489 now. And this,
to tell you how crazy this is, less than 90 days ago, the average days delinquent was 1,300 days.
Yeah.
So it just shows you how, honestly, if you're thinking about, the sludge in the bottom of the barrel, this is what this is indicating to me. All right, Joe, when you draw on top of those lines, I'm going to get you to get your red pen out.
Okay, I'm going to get my red pen out.
Easier to recognize, but Joe, this is the bottom line. We got a whole bunch of loans that are delinquent, that are seriously delinquent, excessive days delinquency. And Joe, it appears, and this is big news, it appears there is a shift in the market by, the administration to go deal with this in a way that says we're not just going to keep sweeping it under the rug. And I've been calling for this to happen for 3 years. So it's certainly been quick.
Yeah.
It's a joke. It's been a quick 3 years.
Yeah.
Like how in the world do you get the residential mortgage industry in such a crazy situation that there's this level of delinquency, and you look at every statistical chart out there and everybody sees it, and then all of a sudden it's just somehow that seemed to be the new norm.
That's it.
It wasn't normal and it didn't make sense.
Yeah,
let me go on record. That's not an official opinion. That's an official opinion. You get what I'm saying?
That's it. That 911,000 has been sitting for a long time, and we got to stop kicking the can down the road. And you're right. I'm glad you said that we're going to start dealing with some of those things that we need to deal with.
There seems to be evidence that is in motion.
Yeah, good. Which means that we'll be looking at some non-performing assets we can be looking at here in the future. All right, so Eddie, we know from the last one, there's 221,000 active foreclosures right now. And by the way, that gray line there, this is the number of VA foreclosures that's tops that off there. But here's the other interesting piece of this, Eddie. There's 221,000 in active foreclosure, but there was only, in 2024, there was only 69,000 completions.
Well, and once again, it's because when you post loans for foreclosure, then people are finally forced to go sell their property to pay off their delinquent loan. So you're never going to have the number of completed foreclosures match loans that are in foreclosure.
No, you're not.
Right. And so, but you look at it from 20 to 24, and we just essentially have had very, very little foreclosed property that's come down the pike.
Yeah.
Right. Which is along the lines that we've been saying. And it's something to pay attention to.
Well, and in here, we had the foreclosure moratorium that it ended in 2023.
But when 23 happened and 24 happened, all that had passed.
Yep.
But nothing really changed. And this is why I've been on my soapbox over this.
That's right. And we love that soapbox. All right, Eddie, you know what? We're going to do this again in 2025 here, late fall, but Colonial, best distressed note buyer, best podcast right here, and Note Expo. And we'll be talking about Note Expo later in the year as well. So that is it for today. Final words?
Every time you see a forecast like we basically have put in front of you, you start realizing we are in a good cycle for the note business.
Yeah.
And we're not producing the news that makes it all angled where it makes us look bad or makes us look good and somebody else look bad. We're just saying it is what it is. There's a lot of money that's shifted to the business for two reasons. People have quit buying rentals and people have quit investing in apartments for Captain Obvious reasons. And that's driving a lot of capital to our space. Mm-hmm. And I spend a lot of time in that area looking at that. And I spend a lot of time kind of continuing to figure out, like, where is there a market opportunity that is in front of us? We just need some clarity on how to see it. And that's why we did the old equity sandwich thing and all that today, because there is an opportunity. It's just sometimes we miss it. So we'll keep working at it. We'll keep monitoring it. But I am saying, this is an exciting time to be in the business. This is an exciting time to be in the business, doing what we're doing. And that's why we're busy, and we're grateful to be busy, but we are busy.
Yeah.
And we'll keep trying to give everybody the best vantage point of the market as it progresses. And you get a news flash that you want us to print or something, send it to us, and
sure,
we'll see if it fits.
So, Eddie, you said this last month or so, and I love it. I've been using it. So if you have rentals, you've got all the control, all the responsibility, and all the expenses, right? You got syndications, you've got no control and no responsibility, right? And with being the bank, well, noting it out, you've got all the good stuff and none of the responsibility, all control. And so that's,
you have control without aggravation.
Control without aggravation. That's right. All right, guys, we'll see you same place, same time next week, 11:05 Central Time. Have a great day. NoteSchool.com/TV for more information. We'll see you soon.
All right. Thank you.
Mm-hmm.